We hold these truths to be self-evident, that all men are created equal, that they are endowed by their Creator with certain unalienable rights, that among these are life, liberty, and the pursuit of happiness. The Declaration of Independence, signed into action in 1776, states that all men are created equal. However, it is evident that all men are in fact different regarding a number of different topics, such as race, class, place, education, and religion. Needless to say, the Declaration does not even include gender. While there are a number of differences that make up society, recently in America, the economic inequality has begun to spiral out of control, defining most of the issues in the world today. The inequality among people defines the way each think and act. According to Witt, the physical and apparent differences represent the macro investigation of sociology, while specifically observing interactions can give more of a micro insight to the topic. Sociology helps each of us understand our own experiences through explaining and indulging in the equality among society. The world is a large place and houses many different groups. However, there are typically three economic classes: upper, middle, and lower. According to Witt, our position in the social structure determines our access to resources and determines the options that are available to us. Where we are shapes who we are. On planet Earth, there are 195 different nations, and the United States accounts for 6.5% of the total landmass. Shown is a map of the world based on GDP wealth. Although the first man came from Africa, it undoubtedly has one of the worst comparative wealths. America, a nation made up of immigrants from other countries, holds the largest GDP wealth. Not only does the United States hold the most comparative wealth, it also holds much of the economic power in the world. The Great Depression, lasting roughly a decade across all nations, began in the American stock market crash. Because of the purchasing power the United States held, during this massive recession, the nation had to hold back its imports. In turn, this caused many smaller nations, specifically those in Central and South America, which relied on exports, to suffer because there were no foreign investors. While the Great Depression was nearly a century ago, the most recent financial crisis holds many similarities. Beginning in this country because of market failures, the recent economic downturn, which we are still experiencing effects from, spread worldwide rapidly. Many believe that the recession began when the housing bubble exploded. However, there are a number of other resources for the financial decline. Reduced interest rates are, perhaps, the sole cause and beginning point of where the issues lie. The interest rate, or the federal funds rate, is a rate which National Bank loans to other institutions. This rate is set during Federal Open Market Committee meetings, which occur on average 8 times in a given year. In times of economic downturn, the nation aims for a fixed exchange rate, making our currency closer in value to that of other nations, easing the flow of international trade. Upon determining where to set the federal funds rate, the committee takes into consideration a number of aspects. If consumption and investment are low, the rate tends to be lowered, making it easier for banks and later consumers to obtain money. From June 2004 to August 2007, this rate was not lowered, and the United States saw its economy grow. A steady increase from mid-2004 to mid-2006 is noted as well. However, in late 2007, at 3 consecutive Federal Open Market Committee meetings in August, September, and October, the rate was lowered. This surprised many economists. Kevin Hassett went as far as to say that our nation's economy had found a lovely sweet spot prior to the rate being lowered. On July 9, 2007, Hassett continued his thoughts in an article. Job growth is strong, but not strong enough to arouse inflation concerns. Federal funds futures indicates that financial markets expect the Fed policy to be on hold for the indefinite future as the economy sails along. There is even talk of the Fed staying on hold through the end of next year. Hassett was clearly shocked and disappointed with the actions taken by the Reserve when the rate was lowered. While the Federal Reserve and government are supposed to be different entities, the two are intertwined. The President of the United States appoints the chairman and board of the governors, who make up the majority of the Federal Open Market Committee. Therefore, should we be surprised that the Federal Reserve potentially caused this recession? After all, Hassett argues that failure is what the government does best. Many attribute the recession to the explosion of the housing bubble, which in large part due to the number of defaulted loans within the economy. The TED spread uses the previously mentioned federal funds rate to measure the perceived credit risk within the economy. TED compares the interest rate in the United States, or the previously mentioned federal funds rate, with LIBOR, or the London Interbank Offered Rate. This rate, which is stated at the beginning of every day, issues the interest paid on 1 month, 3 month, 6 month, and 1 year loans among London banks. Banks worldwide view this rate and use it as a guide in their own decision making. If the LIBOR rate is high and the Fed funds rate is low, issuing a large TED spread, then obtaining loans is viewed as easier in America because of the relative ease in moving money within banks. In September 2008, the TED spread reached a record high. Perhaps the bank's credibility was low because of the regulations put forth by the government. Fannie Mae, or FNMA, the Federal National Mortgage Association, which was backed by the government, bought large amounts of mortgages from banks, packaging them into a single security. Collecting a fee on the mortgages paid, part of which was principal payments, and the other payments on interest, this association would lump the mortgages into a securitized pool. In 2005, the chairman of the Federal Reserve at the time, Alan Greenspan, warned that if these organizations continue to grow and continue to have the low capital that they have, continued to engage in the dynamic hedging of their portfolios, which they need to do for the interest rate risk aversion, they potentially create ever-growing potential systemic risk down the road. We are placing the total financial system of the future at a substantial risk. This statement was issued 2 years prior to the destruction of the organizations, which led to the collapse of the economy. It was regulations that caused massive amount of mortgages to be purchased by Fannie Mae. Had these regulations never been put in place, these unaccredited loans would have never been given. Hassett argues that the regulators likely failed because they became captives of the firm they were supposed to regulate. There have been many writings and findings concerning the SEC, Securities Exchange Commission, and banks. SEC attorneys inside the organization become friendly with the banks they oversee. Eventually, these attorneys leave the Securities Exchange Commission to work for the banks that they had looked over. In a number of books and studies concerning these findings, meetings are discussed where the SEC members and bankers will come together to illegally discuss the economy and other issues. Some wonder why the government has not found this and taken action. The Declaration of Independence states that to secure these rights, governments are instituted among men, deriving their just powers from the consent of the governed, that whenever any form of government becomes destructive of these ends, it is the right of the people to alter or abolish it, and to institute new government. Though the financial crisis was not averted, it is not too late to change. Together, we can change the government. Yes, we can.